traders, Gary Wagner here, just about 9:30 in Honolulu, 3:30 in New York on Thursday, the 2nd day of July, 2015, and this is the daily report for gold and silver. Although well off of the lows, and we will absolutely cover that in a second, we do have gold under significant pressure, trading off about $6 on the day, currently trading at 11.63. Now, it did hit a low this morning of 11.55. We had a stop in place at 61. That was obviously hit. We'll talk about that in a moment. But following the release of the jobs report, in which the data came in really under what was expected, there was the sense that the Fed, in fact, might have to prolong the initiation of rate hikes, which many believe could start as early as September or December. And the Fed is on record as saying that the most likely step that they're going to take is going to be to initiate at least the first rate hike following these really low interest rates over this recovery period. Silver also showing red today, but realistically it is unchanged on the day, currently trading at 15.57. When we look at the lows and highs, 45 on the low side, 75.5 on the high side. So traders, the first line of business is obviously to discuss our most current trade, that trade in which we did enter the market from the long side at 78. Our stop was at 61. Quite obviously, when this market traded down below to this low here at 55, we were stopped out. Needless to say, it is something that I would prefer not have happened, but it is what it is. What I do find noteworthy, though, is when we take a look at the way this market recouped and the fact that we hit this low, and as soon as the jobs report came out, you saw buying entering the market, whether it was short covering or initiating buys. What it does is it gives us a candle type that we've identified on many occasions, but is quite interesting and noteworthy, and that is a hammer. Now, a hammer is part of the umbrella group of candlesticks on the bottom. In other words, after a defined correction in the market, or lower pricing in the market, I should say, you can either have this candlestick form or what is simply called an inverted hammer. Now, an inverted hammer would have the body, the real body at the bottom of the range, and then it would have a long tail at the top, and that would be called an inverted hammer. These same candlestick types, when found at the top, though, have completely different names. You would get a hangman or a shooting star. What is important about a hammer is the fact that once we hit this low, the market shot back up, and most importantly, when you look at the real body size, you can see that the relationship now between the open and close has narrowed greatly, and we've dramatically come off of those lows. And so that is fairly significant. That would be on the bullish side. Of course, to take that kind of a call, you would really, it would necessitate a confirming candle. A confirming candle, of course, would be the following day. You would have to have a green candle with a higher high, higher low, and you would want the close and the high to be well above the high prices in the hammer. It's a very simple one candlestick pattern, or single candlestick pattern, I should say. So you have to take it in terms of the criteria with a couple of other filters before finding it to be a real reliable indicator in the market. Now, as I said, that's really the bullish sense of what we could see develop in the market. In terms of a bearish sense, let's take a look at these most recent lows and most recent highs. This low here, this low here, this high here, this high here. When we look at the market in this way, what we're seeing is a series of lower lows and also lower highs. And that, of course, is indicative of a market that is trending lower. And we can acknowledge that we are looking at this market with a current bear count. However, within that bear count, and as you notice, I've pulled up another chart. This is in Japanese average format, and it's a half-a-day candlestick chart. The other thing that we really want to acknowledge and be sensitive of is whether or not this most recent low that we've gotten right in here has actually signaled a basic bottom in the market and will go into some sort of corrective ABC. The whole rationale behind our last long trade was the fact that it was my belief, incorrect at this point, but my belief that we had pretty much bottomed out and had terminated this 5 out of 5 in terms of our current Elliott wave count. We now can easily see when we look at this as a wave 3, our wave 4, this being our wave 5, that we could in fact have kind of concluded that by washing out at 1155. At the same time, when we look at the basic channel that we're in, we are still absolutely in a defined down channel, and we have not gotten any kind of confirmation on a technical basis yet that we are in fact going to move up from these prices. The one thing that I can say is, again, this is a very narrow channel, but it hit the bottom line of this channel, and so it wouldn't surprise me now to see prices move back to the upper ends or top of this channel. So traders, it is for that reason that I have just sent out just moments ago a recommendation to go long gold. Now I realize that we got stopped out. We were stopped out at 61. Traders taking that call. The market's trading roughly at 65 right now. It was at roughly 64 when we sent out the trade alert. So the difference between 64 and 61, of course, is a $3 spread. In that way, if the market does move up, as I believe it really could, it allows us only to have lost really the differential or $3 on the trade. Also, I have converted this Japanese average chart, still half a day chart, but I have converted it into a standard candlestick, which will give us, of course, our true highs as well as our true lows. We can absolutely see that we hit the lower end of that channel. In fact, let's go ahead and kind of compress this chart. And my sense is that with the market trading to this new low, meaning 55, as opposed to roughly 61, which is where that stop was and why that stop was there, we absolutely at this point, I believe, have a high probability that we have completed our 5th out of 5. If that's the case, from here we will enter some sort of a corrective period. Now, a correction on a bear count, realize we had a bear count 3, 4, 5. We should now go into some sort of an A, B, C. Of course, this isn't being drawn to scale, but my sense is that we could absolutely see this market bounce at least as high as, call it 1171, 1172. But I think we have the opportunity actually to see this market rally and rally up until about, call it 87. That would be my first target, and that target is simply based upon these most recent highs here. So the final chart that I do want to look at this morning in terms of gold is going to be a very, very short-term study, 240 minutes, a 4-hour candlestick chart. It is unusual that we would get stopped out and re-enter the market all in the same day. But traders, we are living in unusual times, and I believe that this action is the most prudent move we could make. We now have this market trading roughly at 65, 66. When we look at the last couple of bars that have come in, these candles here, these each represent 4 hours. You can see that we did come up. This was earlier the highs that we had, and we're now flirting with moving back towards those highs, but these last two candles have gone green. We are getting that pivotal kind of move that we look for in the market. And as I said, my belief is that we have at this point completed, in terms of our wave count, 5 out of 5, and we are now above 66. So whether it's short covering or buying the dip mentality that's going on here, we are seeing a genuine small rally occurring in gold. So traders, what about silver? As you know, we have been flat silver. These last couple of trades have been in gold and not in silver. We have been looking for lower pricing in silver. We now have the market trading up about 4 cents, trading roughly at 1562. That is what you would see on a standard candlestick chart. This is our Japanese average chart. And my real question right now is whether or not we've washed out the short plays in this market. We are getting our first pivotal candle, this also being a half a day chart. we'll have to see, because if we do get some recovery here, my sense is that we could have initiated a bottom. It's come very, very close to where we thought this market could go to. But quite honestly, I am not convinced wholeheartedly that we've bottomed out, but it's certainly something we do want to take note of and watch very closely. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.